Hello and welcome back. So we have Ali from Mortgage Scout back into our show. Ali, how are you today?
Doing well. Thank you for having me again.
Thank you very much. Everyone is talking about trust lending. You hear Macquarie cutting off trust lending about maybe a couple of months ago. So I think
True.
this is one of the topics that I'm looking forward to, and I think a lot of viewers and listeners would be looking forward to as well. And so we are going to break this down into various parts. We are going to talk about what is trust lending, how does it matter, what are the changes, why are the changes, how does the landscape change. For viewers and listeners, talk a bit about like how does trust lending works, in the most basic sense for a first time viewer and listener.
So, first thing I would like to highlight when we talk about trust lending, and we do this pretty much day in, day out with our clients where we're educating them about how it all works, right? I think the biggest myth is that trusts are these things that rich people have
Yeah.
where they can, pay no tax and get all the money that they can,
Yeah.
right? So, number one, understanding that trust is just a structure, and especially in Australia, for anybody that's opened an ABN for themselves knows how easy it is to set up a structure.
Yeah.
You can use an account and do it yourself however you like it, but essentially it's an entity that is separate from your individual that then goes and buys the property.
Yeah.
Right? From a lending perspective, buying a property under a trust still brings your personal servicing capacity into play.
Yeah.
Right? And we're only going to be talking about residential trust lending here because then obviously trust lending is its own dark hole that we can go in.
Yeah.
Right? So I would say, yeah, the first thing you got to understand is that trusts are a corporate structure that you put in place that then owns the property and the loan when you go to buy that property.
Yeah. And I always explain this to my clients that trust, and naturally people think that trust is this magical sort of being or magical bullet, or the silver bullet that solves all the serviceability problems, right? It's not the case. How do you structure it? How do you go around putting the right assets in there in order to create the serviceability within the trust? How does the servicing comes into play? Personal guarantees, and people using the trust wrong versus right, corporate beneficiaries and non-corporate like let's go into a bit more detail about some of those things.
So all these questions that you've asked, right? Now you got to bear with me because this is going to take a while.
Yeah.
So
And before you do that, look, I want to do call out that this is not financial advice. This is not financial planning advice. This is not tax advice. This is a mortgage broker sitting in front of me, and I'm asking all of these tax questions to him. And so, of course, speak to your own accountant, speak to your own financial advisor, speak to your own financial planners. This is us looking at all of this purely from a mortgage side of things, and nothing to do with tax related issues.
100% agree with that. And I think us highlighting the factors here today just to educate the people as to what goes on behind the scenes, right? What is the bank actually looking at? What is the accountant even talking about? Right?
Yeah.
Why is he saying what he's saying? And so that you understand the background information, and that could be different applications of how it impacts you personally.
Yeah.
So coming back to your question about trust lending in the mortgage space, the first thing that you got to understand, like you said, that the trust is just a shell. At the end of the day, Australian banks wants to see income, right, and servicing. What servicing means is that after you've paid, or the trust has paid their expenses, can it meet its liability, i.e., the repayments back to the bank?
Yeah.
Now, because the trust is an empty trust, it has no income right now. The only way for you to service under the trust is to use your personal income, which is why you go on as a guarantor to that trust.
Yeah.
Right. It is similar, sort of, to when the parents give their guarantees to their kids.
Yeah.
Now, obviously, that is more on a security basis where the kids don't have a deposit. So essentially, the money is coming from the parents, right?
Yeah.
Or the equity is coming from the parents.
Yeah.
Whereas here, you, the parents of the trust, are giving your income up to service the property under the trust or service the loan under the trust.
Yeah.
Right. So that's the first point, that we got to understand that the individual's income is still a major factor. So all these rules that you see out there about unlimited borrowing capacity only work if you've got unlimited income, right? So yes, you can structure it around, but at the end of the day, if you're unemployed and you set up a trust, doesn't mean that you can go and get a property under
Correct.
the trust, right?
Yeah. And, pausing you there, it also means that, no matter how much is your income, if your borrowing is used or expanded or exposed outside the trust, the trust is not going to magically solve the problem. And that is one thing that a lot of people don't understand, that trust is not a solution at the end of the cycle. It's the solution at the start of the cycle, right?
100%. So, like you said, not just the income that you're getting in your personal name, whether it through be your job or your company, whatever it is, but also your personal liabilities matter, right? So, if you've got a $50,000 credit card or $2 million home loan in your name, then obviously that is going to impact not just your servicing, but the servicing under the
Yeah,
trust, right?
yeah,
So, like you said, the servicing doesn't change for when you buy the property under the trust today.
yeah,
What matters is how you structure it for better borrowing capacity in the future,
yeah,
right? And so if I can go to a bank and get $500,000 loan under my personal name, if I go and set up a trust, that $500,000 borrowing capacity is still the same,
yeah.
right?
Or in fact, it might slightly go lower because of all of these negative gearings and everything
Oh,
that comes into place.
100%,
Yeah,
right? And a lot of the times, even though the client has a borrowing capacity of 500,000 in their personal name, when they go to get it in a trust, they might not even get it,
yeah,
right? And they're
yeah.
brought down to 350, 400, which is not enough to buy a property sometimes.
Yeah. And so I'm going to talk in two time horizons, the old horizons and the new horizons, which is about to come. And we'll talk about it as well. There were nuances in place where, in order to get the trust lending, some banks would, put higher interest rates. Some banks would put in minimum deposit requirements, in order to, deter people from not using the trust. Let's talk a bit about that, because of course, from banks' perspective, trust lending is dangerous, right? They know for a fact that their repercussions of getting that loan back or getting that property back while it's sitting in a trust is there's a limited recourse around all of this, and that's why the personal guarantees come in place. That's why higher interest rate comes in place. That's why higher deposit comes in place. So banks were already thinking about, hey, trust lending is risky, and I'm going to provide for a risk margin in a lot of these things. And so talk to us a bit about this property spookers who used to talk about, hey, I'm going to use this trust to build unlimited borrowing. And how does it work, or how did it used to work, about it being disconnected from your personal capacity and the accountant's letter, the magical accountant's letter?
So I think the important factor in understanding this is that the banks use certain policies when they're assessing your personal position. So let's say you're earning $100,000 and you go to the bank. How do they decide on how much loan they're able to give you? One of the major factors in that is income shading, right? And the other factor is the interest rate buffers. So let's take an example, right? You own a $1 million property, right? And that $1 million property is generating, just to give an example, $1,200 in rent, okay, per week. And your interest repayments, and let's say these are interest only repayments, are only $1,000 per week, right? So essentially, you're positive $200 per week. That's $10,000 in a year.
Yeah,
If you go to the bank and you tell them, hey, I'm actually earning $10,000, that's not how they look at it,
yeah,
right? First thing they'll do is that they'll shave your rent by 20%,
yeah,
right? So instead of $1,200, the banks are considering that you're only earning $960 per week.
yeah,
Then you've got the interest only repayment. Number one, when you structure an interest only repayment, it might be for 5 years. The remaining 25 years, you still got to pay principal and interest.
yeah,
And because it's actually 25 years, not 30 years, then your principal and interest repayments jump up.
yeah,
Then the banks add another 3% interest rate buffer. So if your interest rate is 5.4%, the banks are actually considering it at 8.4%. Because of that, your actual repayment of $1,000 jumps up to like $2,000 per week in the
yeah,
bank size.
yeah,
So suddenly you've gone from positive $200 to negative $1,040 per week,
yeah,
right?
yeah,
And then you go to the bank and you even try to refinance, and they'll be like, sorry, we can't do it,
yeah.
right?
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years. And there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book, it's easy to read, it has a lot of stories, it has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Mohsin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book.
And I think that's the biggest difference between, assessing where your cash flow sits versus where your actual cash flow sits. And I think that's the disconnect that a lot of people don't understand.
100%, yeah. And so now imagine this, where when you go to the bank, you're trying to get a loan. In the bank size, you're negative $1,000 per week, right? That's $52,000 a year. So if you're earning $100,000, it's all gone already.
Yeah.
Now imagine the same property is in a trust, right? And in your personal credit file, that loan doesn't show up because the loan is under the trust.
Yeah.
But your directorship to the trust does show up.
Yeah.
Now, when the bank asks you about this trust, then the question is whether that trust can meet its own liabilities or not.
Yeah.
As in me, as Ali Nanji, do I need to put in that extra $1,000 into the trust to service its debt or not?
Yeah.
If I'm not physically putting the money into the trust and the trust can meet its own liabilities, that's where the accountant's letter comes in, right? And essentially the accountant is confirming that Ali Nanji personally is not putting any money into the trust.
Yeah.
Right? Now, it's not always the accountant's letter. You could even get a tax return off the trust showing that it has a $10,000 taxable income.
Yeah.
That means that it's actually making money,
Yeah.
right? And so the bank will then, if you provide an accountant's letter, they don't consider the positive $200 per week, but they don't also consider the negative $1,000 per week. You're just at zero.
Yeah.
Right? And so that trust then has nothing to do with you and it's out of the picture. So if I personally was earning $100,000 and I can go and borrow another $500,000, then that $500,000 borrowing capacity is intact regardless of the trust.
Yeah. And so ultimately what the bank is doing is, instead of making the assessment of the trust on its own self, what they're doing is they're basically deferring that assessment to an accountant and saying, hey, you make this assessment for us, take this assessment at the face value of whatever you say, and we're going to go ahead with this. And so they're naturally, just at face value, there's so much thing that is wrong with this, right? So let's talk about the risks, and so we've talked about why does it matter, how does it work. What are the key risks in the current scenario?
Yeah, definitely. So I think the first risk is, why do the banks have the 3% interest rate buffer in the first place, right? Why do they have the income shading in the first place? So, and again, we've experienced this very recently, right? Where people who got loans at 2.5% interest rates, and this was the first time they were buying property, they're buying a property for $1 million and the repayments are only $800 a week, right?
Yeah.
And they're like, oh, why am I paying rent? Let's just buy property.
Yeah.
Now they've gotten into this property and suddenly the interest rates have gone to 5.5%.
Yeah.
Because of the fact that the banks have put that 3% interest rate buffer, technically speaking, they've already considered the fact that I can afford to make the repayments even at 5.5% interest rates.
Yeah.
And so that's why the actual mortgage stress has not been as much as you would have seen in the media.
Correct.
Right?
Yeah.
The number of people that have actually defaulted is not as high, simply because of the fact that the banks had considered it in the first place.
The talking to that point, I think when you talk about mortgage stress or mortgage default, like the bank's definition of mortgage default is very funny compared to what people's definition of mortgage default is, right? You are 2 days behind on making a payment. That's a mortgage default in their eyes. That's a mortgage stress in their eyes.
And I think the idea of people actually having to sell their property and back on the road or back to renting is what I'm talking about, right?
100%.
And you'll notice that comparatively to across the other parts of the world, Australian properties do so much better because of all these buffers that the governments and banks have put in place in the first place. Now, because of trust lending, imagine you remove those buffers. So technically speaking, that accountant letter does not say whether the trust is positive by $1 or $10,000. And now the trust is not positively geared, for example. Then you're stuck. And imagine if you've got 5 properties in trust, then you're
100%.
in real trouble.
Yeah,
right?
definitely. Yeah.
However, if you had these same 5 properties in your personal name, you wouldn't have gotten the loan in the first place unless you could afford it.
Yes. Yeah.
And this is where I think the major risk comes in place.
Yeah.
There is another aspect of the risk, not as related to mortgage, but rather the structure of the entity themselves. So with trust lending, you've got the trust itself, and then you've got the corporate trustee.
Yeah.
Now the corporate trustee has a director, and the person who's applying for the loan is usually the director and the beneficiary of that trust, etc. However, all of that is only defined by the trust deed.
Yeah.
Right?
Which is a document that sits in a OneDrive document.
Exactly, which is a document that sits in Google Drive. Previously you would have to physically take it and get it stamped. No longer the case anymore.
Yeah.
Banks are accepting digital signatures. All of this is in this, Google Drive, OneDrive that can be edited in Adobe, right? Yeah. And so that's where the banks lose control on who actually owns or benefits or is liable for that property, right? So if I bought a property and I go and change the trust deed, no one's aware of it. There's no track. There's no, Equifax for it. There's no ADO portal for it. There's nothing.
100%. Yeah.
Right? And so this is where people who are trying to bypass, for example, FIRB, right, where you've got international investors putting money into it. You've got super funds that are trying to buy property in personal names or family trust, unit trust, whatever it is. This is where the remaining part of the risk lies, right? Where, look, at the end of the day, everybody's happy when they're getting their comps, right?
Yeah.
The banks are there to make money by giving you the money.
Yeah.
But what happens is when things go belly up, and the bank goes and tries to seize those properties or seize the trust or take charge of the trust, etc., and then you get presented a trust deed that's completely different, then what do you do?